Thank
Gentlemen,
you.
Kirkland Capital Group, great to have you guys here with us today. The floor is yours for the next 20 minutes.
All right. 20 minutes. We'll have to get through this pretty quickly. Well, thanks everybody for attending, and we're excited to tell you a bit about our fund. Honestly, this is a little out of the ordinary for Chris and I. I would say most of the time we're not talking about our own fund, except maybe on a phone call with someone directly. We're doing a lot of educational stuff. So, bear with us as we kind of walk through this as we usually do more educational stuff. But let's move on here, Ralph. And our disclaimer notice to reader, obviously we're not going to actually read that, but we can tell our lawyers, yes, we've shown this to you. And moving on, a little bit about the fund. We are specifically a debt fund, or we can call it a fixed income fund. We've delivered over 11% last year. I know that's important for a lot of people, although our target's 10%. We think we're going to beat that again this year. Where do we deploy this money at? It's what we call micro balance commercial real estate loans. And that may seem like somewhat odd to you, but we had to come up with a new term, seeing as most real estate loans in the commercial space can be 10, 50, $100 million easily. When you're talking about loans that are less than $1 million, well, those are micro, tiny. There was no one else really doing that in the bridge debt space. So we saw a gap in the marketplace, and we launched this fund a bit over 3 years ago, based on both my experience in the industry, doing underwriting and auditing, and Chris's on the fund management side. But we're really excited because we saw this not just as a great place for investors to make money, but also a place where we saw people needed this kind of money to go and rehabilitate middle income housing in smaller markets. They needed to be able to do mixed use properties. I mean, this is really the backbone of America, places where small business thrive, places where workforce housing is in smaller towns. I mean, this was super important. So we're excited that we're able to launch this, and it's been such a success so far. Moving on. I'm going to let Chris now talk a bit about the opportunity and edge, and a bit about our investment strategy.
Sure. Having been in the alternative investment space for over 20 years now, across a variety of different strategies, one of the things that when we saw this opportunity years ago, or if you're an investor looking at any alternative opportunity, you really should assess, well, you can find something that's in a niche market. That doesn't necessarily mean it's inefficient. And inefficiency goes back to, some type of occurrence within an investment space that's allowing you to create an excess return, and more importantly, allowing you to create an excess return that is repeatable. One of the things that we've seen, and a lot of people talking private debt here, and the Fed was nice enough to keep the ball rolling for us by another 25 basis points. So thank you very much for that. But we've got, one of the inefficiencies that started back, in 2010 with Dodd-Frank was bank regulations. You basically had a number of people who were your lenders in this space step out or be regulated out of the space, opening up the door, across not only real estate, which we do, but venture, consumer, corporate. So you had a huge opportunity there. In particular, in our little fragmented space of microbalance commercial real estate, it was very, very tough to find data of just how big the market was. So we went to all the big data providers. And I want to say I loved the idea that it was hard to find data. It wasn't a lot of eyes on this space. So that's a very good sign that, hey, I can't nail down exactly what's going on, which means you probably don't have the big guys worried about it. And so we liked that it took a while to get an idea of, well, how big is this? So aggregating a number of different data sources, we kind of came up with, hey, in this microbalance space, in commercial real estate alone, you're still looking at a fairly large market and still growing. Other lenders, as Brock mentioned, they just weren't in this space for a variety of different reasons. You had a very successful run in private debt, so people raised a lot of money, and these small loans became de minimis to their portfolio size. So they graduated up. One of the things that we're very focused on, and I learned this as a hedge fund trader for a number of years, once you find an inefficient space, and that's what you want to be in, that's where you need to stay. That's where you can continue to generate that excess return. That's the inefficiency you're taking advantage of. So, we want to stay in that space. We understand our capacity, and we're not looking to grow to a size that will migrate us out of this small niche. Obviously, as I stated earlier, the Fed's helping out, market volatility, rising interest rates, uncertainty in the banking. I mean, everything across private credit right now is benefiting from this inefficiency of where the Fed has been nice enough to increase rates. So everyone's capturing a greater return while banks are continuing to be, and we'll get to, we may see even more regulation coming around that's going to continue to regulate them out of this space. One of the things that we also like is geographic diversification. Being able to play in multiple spaces in our fund. We'll lend across, the 48 contingent states right now. So being able to find those opportunities and work with the borrowers where the opportunity is presenting itself. That's one of the things that we want to bring and be able to capture for this fund. And we have an expected return of 10% with very, very low correlation. Private debt generally has low correlation to traditional markets. So as an investor, you want to be looking for that inefficiencies. Are they more correlated to your public REITs, or are they kind of waxing and waning with the flows of large money that we saw in 2021, sometimes even in, we love fix and flip and single family residential, but you are definitely dealing with a little bit of, correlation there to large money flows, as that's a space where the big guys will go in and out of when they see the opportunity. Next slide. And the next slide is after you've assessed your inefficiency, you want to go into edge, the team, the people who you're investing in a fund. You're going to say you're going to invest in our fund. Well, who are we? What is the edge that we bring? What allows us to recognize the inefficiency and then capture that? For us in particular, I have a very long history in capital markets. Brock has experience in real estate and technology and underwriting. He came, one of the things that was great is we walked in with an existing network and access to loans, a deep technology experience, allowing us to constantly increase efficiencies of systems because we do run higher volume because we're running smaller loans, our average size of loan is probably 550,000. That deep understanding of how to run a fund management. We launched in January of 2020. It was an interesting time when you came into that market and you also realize you're in a left tail event. And being able to keep your calm in that. Me personally, I've been through multiple, been on the front lines of a lot of big problems for some of the, the funds and groups that I worked with. So it allows you to keep sort of that calm, cool. You've been through the cycle and you can stick to your knitting and move through, and also be dynamic to take advantage of or avoid some of the problems that might be coming through. We have like I said, the loan program and guidelines. I mean, we have a process and procedure of how we're building out and doing underwriting in all of these loans. And we continue to adapt that as the market throws us these changes. So, I mean, having the knowledge of and forthright to sort of see what's happening in the space, and then being able to adjust, whether it be your technology systems or your process, to take advantage of that. That's something you want to have a team be able to express. And we're always risk first. Everything we do, we assess the risk first, and then we try to maximize that return for the risk we're taking. And so that's what's creating, this, lucrative aspect of, microbalance commercial mortgages. Next slide.
Yeah, one thing I'll mention there too, Chris, just for everybody, is, we do look at risk very closely. We're always looking for ways to mitigate risk. One of the latest things that we did was we implemented where we're going out on every single borrower guarantor and we're getting their tax records. It used to be just on someone who's self-filing taxes that would go get a 48506, et cetera. Now we found a service that we can go get on every single loan. We're going to the IRS and getting, have you filed your taxes? What do you owe right now? Which is revealing some new information, and it's great. It's just one of those places we look at, and we added it in order to reduce risk, because we want to make sure the borrowers have that capacity to play, and they've shown good history for themselves.
Exactly. Brock, you want to talk a little bit about the overall strategy?
Yeah. So conservative valuation. this is one of the things for debt funds that, for Chris and I, part of this was just scratching our own itch. He mentioned we started actually at the beginning of the pandemic. We started before that, so we didn't know that was coming, obviously. So even when an investor pulled out, Chris and I, it was always our intention here in scratching our own itch is we have a significant portion of our own net worth in this fund. Why? Because we believe in it. We built it in some sense for our own selves, wanting something super conservative. Well, that meant as is values. So we make a loan, maybe it's 70%, 65% portfolio wide. We're still under 60% LTV portfolio wide, but that's based on as is value. Currently, what is of as is value, not a future ARV or after repair value or some sort of guesstimate about what the property may get in the future. It's based on right now, what is that property worth? That's what we base our loans on. That way, if something goes wrong, it's not hard to go out and get all of our money back for the fund. 12-month loans. So we're not really having a lot of interest rate risk out there. We can roll those over as well. So we're already starting to see that uptick in the returns in the portfolio because we're now writing higher interest rate loans, and that started in the last 3-4 months. Borrowers have an exit strategy. We only do 12-month loans. Now we offer a couple of 6-month extensions at our option if they've been paying on time, et cetera. But really, we want to see a high confidence exit that they have lined up already and a way for them to get there. So we underwrite all of these loans knowing that they're going to have to get to a certain DSCR, or they're going to have enough cash flow or whatever it is required for them to get out of our loan. We look at that ahead and we underwrite that as well. Underlying properties. Another way we reduce risk is we only look at income producing or potentially income producing properties. Let's say if it's an owner occupied or maybe needs a little work. We're not looking for construction loans that can take 12, 18, 2 months or 2 years to get done and no income, by the way. We're not doing any raw land. We want income producing properties that we can turn if there's a problem and there's income being produced. The senior debt positions, we only do first lien loans. Again, so that we're in first position if something goes wrong. Full recourse, that means personal guarantees. If there happens to be a situation where we're not able to go get the entirety of the loan amount due from that borrower, well, we can go after them personally. There are other properties, other holdings that they have. So they're basically on the line for that personally if something goes wrong as guarantors. And of course, we have a diversification by property and state. So we are not just focused on one state or one area where maybe if that area does bad, or in the case of maybe there's certain laws that are being passed that are not very friendly to investors, active real estate investors, or even us as a lender in a particular state, we're not overexposed to that. So we see diversification across not just states, but also property types as well. There are certain property types right now we don't have any office, probably a good thing. Not that there's not office out there. That's probably a good buy right now. That's probably the time that you can go and get some great buys on office properties right now. But we're really focused on those that have stable asset prices. All right, next slide. A little bit about us. As you can tell already, Chris has a deep background. His entire career has been spent with hedge funds, fund of funds, really all that due diligence. I'm very happy that we were able to put this thing together. Basically, I bring my real estate underwriting and real estate technology, as well as my high-tech technology to the platform here. And we've been able to build a team up on the underwriting side as well that I've built out, as well as the network that I've been building out for years among loan brokers where we source our loans. And it's great to be able to pair with Chris because I didn't know anything to start with here about fund management, but Chris has built funds for institutions his entire career. So from the get-go, what was nice was being able to have him come in and really build out our fund at an institutional level. That means it was fully audited from day one. That means that we have third-party administration from day one. So, in all the accounting and all the stuff that goes with that. So really appreciate his background. And really the two of us together, we produce a lot of educational content as well. Next slide. And we've started, really building out our team as we've gone along. And we're actually about to add another person here. She starts on Monday, another accountant underwriter, basically. And that's what really focus on is top level people who are at the top, top 10% out there. And we're fully remote. Not that that really means anything, but that means that we really can go out there and hire the best of the best and get them. And that's what we've really built here as a team. Next slide. Chris?
Yeah,
you
one of
wanna
the
talk
key
about our-
things, anytime you're building a fund, you want to understand, you're not doing it alone. You got to have support at every step. So, we work with Garashi Law in, real estate and securities law. Obviously, we are audited. So Spicer Jeffries, since day one, has been coming in and auditing the fund. They also run all of our tax. And for this fund, we do provide, K1 from Spicer. And we have a fund administrator. I came from a world where I sat on some of the AMA panels in 2009, deciding what the new world was going to look like and how funds are going to do it. So a lot of you might not know, but pre-08, a lot of funds were self-administered, and that became kind of a no-no. So like Brock said earlier, day one, we built this to be as institutional as humanly possible. So had fund administrator coming in, day one and looking over our shoulder and providing information and access for the investors. And on the on the underwriting side, we're using a lot of different systems from Clear Capital, CRE Intelligent, and as Brock mentioned, tax status.
There's the tax. That was the one we just added that enables us to check every single guarantor to see where they're at, whether they pay their taxes, file their taxes, et cetera. Next slide.
Yeah.
Here's our current geographic exposure. We are no longer lending in California once those two loans are paid off. We just felt like it wasn't a great place for us. You may see instantly kind of key in on Michigan. We have done a lot of loans there. Partially is that's been an up-and-coming place. Now, on all of our loans, we go and do we pull economic numbers. That's credit card spend, that's income, a whole bunch of stuff that we're looking at for every market that we're in. But over and over, we've seen that there are opportunities there. Although because it is a little overweight, we actually charge 50 basis points more, which gets passed on to you as an investor. And by the way, that's how we run our fund in general, is that anytime that we, whatever the risk level on a loan, say Michigan, we feel like, well, we're a little bit overweight on it. So if we do a loan in Michigan, we're going to charge 50 basis points extra to the loan, to the borrower. And that gets passed on to you because we have just a steady 1.5% a management fee plus expenses. So you get rewarded for those things directly as an investor. But we're slowly but surely expanding the number of states here. We do not a whole lot in our home state of Washington, just because things are so expensive there. Heck, you probably know that in Seattle you can barely buy a house for 1.2 million. So when that's our max loan amount, well, that's why we're in the states we are. But we find that there's a lot of opportunity in those states as well. Next slide, please. We've talked about being across multiple types here. Again, multifamily, light industrial, hospitality. We're pretty happy with the spread that we're at right now. We're seeing actually a lot more multifamily coming in just because of what the bank changes are. So we're seeing a lot of fallouts that would have gone the bank route. They're tightening up or just saying, no, we're full up or whatever. We're happy to take those multifamily for sure. Mixed use, for us, that's defined as basically multifamily apartments or one or two apartments or more over a retail. We like those kind of deals because that multifamily aspect helps to stabilize that asset as well. And so you could almost toss around 50-75% of that mixed use into multifamily because that's what it is. Next slide. All right, Chris.
We won't spend too much time on this. I mean, this is just, we've been around as of April. This is our first, our full 36 months. We've been exceeding our goal of, 10%. thanks to having a lot of consistent growing loan demand and having the ability to go in and write higher rates. One of the things that we're able to capture and one of the inefficiencies of this space, allowing us to continually pass on larger returns to investors, is that supply and demand imbalance in these micro balance spaces. We have pricing power, we have contract power, and there's such demand. If a particular borrower doesn't like our loan documents, they want something different, or they want a cheaper rate, well, right now it's very easy for us to just pass on, because that's fine. Often not, we'll see some of those people come back because they can't find what they really want. But we have a lot of demand in our face. And one of the things that we're always working with is, hey, well, what's the right rate to get the right loan? Like I said earlier, we're very risk conscious. So we're not on this hunt to just charge huge rates and try to maximize that. What we're trying to do is we want to take the right risks, limit exposures and hardships on any of these loans, and then be able to capture the right rate. Here's another performance slide, just from a comparisonal standpoint. We're all about consistent returns. A lot of people, I know we're comparing apples and oranges here, but a lot of people are looking at private debt for the first time, and the rest of their portfolio may hold these other assets, traditional bonds, traditional equity, or maybe even REITs. So it's the reason we sort of threw this into the deck, is giving someone, a comparison of, well, what has been occurring over the last years compared to what you might hold as an investor. Next slide.
Yeah.
Here's some of the parameters that we had already mentioned. Our fund is now actually just over 20 million. LTV pretty low, low duration. And one of the things that I like to see here also, when you're looking to add something to your portfolio, is, how does this generally relate to what you may already own? If you're adding a new asset class or a new investment to your portfolio, is understanding the cross correlations between what you own. That's going to increase that risk adjusted return for your portfolio. So, if you guys want to come back and talk about correlations and impact the portfolio, I love that stuff. So I'll talk to you as much as you want on that front. Next slide. Here's just another risk adjusted return, looking at volatility of these instruments given the returns. I mean, you can obviously see that we've, the S&P 500, since April 2020, hasn't given a bad return, but you've had some volatility in there. So that's one of the things that I just like to show. This doesn't mean the S&P is bad. You're taking some risk, understand what you're taking, and the nature of our product is meant to be very, very low vol. Our goal is not to beat the S&P 500 by any means, but we'll have our day, which, I mean, obviously in 2022 we did. Next slide.
Yeah, let's just skip through these, because we'll allow everybody to grab the slides later.
Yeah.
These are pretty self-explanatory. Let's go to the last slide there, and yeah, here we go.
The QR code, I love it. Scan that QR code. Visit kirklandcapitalgroup.com, and I posted a link to kirklandcapitalgroup.com in the chat about 20 minutes ago as well. Gentlemen, we've run out of time, unfortunately. I got to move along.
Not a problem.
The next,
you can still invest from California. I'll answer that one. And the minimum investment is 100,000. We'll answer those. Otherwise, reach out to us. We're happy to answer your questions. Thanks so much, Jimmy.
Yeah.
Sure.
Thank you,
Thanks,
Brock.
Jimmy.
And thank you, Chris. And yeah, please do reach out to those gentlemen at Kirkland to learn more. And thank you so much, you guys, for joining us today. Really appreciate your time.